recording is offered as a general source of information only. Contents are not intended as a solicitation to buy or sell specific investments or to provide tax, legal, or investment advice. Always seek advice on your specific circumstances from your financial advisor. Views of guest speakers may not be shared by Cory Vance or Arctic Fox Financial, Inc. Thank you, everyone, for joining us tonight. This is Open Office Hours with me, Cory Vance. So the Open Office Hours is just a casual, no pressure way for you to get to know me and my special guests, and learn how easy it is to access not only a financial advisor, but also other professionals that can help you grow your business and your portfolio wealth. So that's why I created Open Office Hours to give you that chance to get to know me and a guest in a really casual, non-stressful way. And so I create financial plans for my clients, and I give financial advice. And who I help the most is I help small business owners to grow their business wealth and portfolio wealth together as two parts of one holistic financial picture. I don't see them as separate things. I don't think you need separate advisors for the two. And so I bring together my experience, my training, my connections with people inside the financial advising industry and outside to help you, like I said, grow your business wealth and your portfolio wealth. And if done well in a coordinated way, those can really help each other, each side of the half, to grow significantly faster and safer, and give you and your family greater financial freedom, funding of the lifestyle that you went into business to enjoy, as well as eventually a successful exit from your business and an amazing retirement. So that's what I'm all about. And my special guest tonight is Sydney Widmer. Sydney is a mortgage specialist, and so she's a fantastic mortgage broker. I have referred clients to her in the past, and she has taken amazingly good care of them. And so that's why I wanted to bring her on tonight and give her a chance to showcase who she is and what she does so well. And so, Sydney Widmer, welcome to Open Office Hours.
Cory, thank you so much for having me. It is always a pleasure to be part of your Open Office Hours. And obviously, I greatly enjoy the referrals that you send over. It is such a compliment to know that you have trust in me when it comes to your clients' mortgage needs.
Yeah, well, you're welcome. And it's not without good reason that I do that. And why don't you tell us a little bit about yourself, your background, and that kind of thing, and before we get into the more casual conversation?
Yeah, absolutely. So like Cory said, I am Sydney Widmer. I'm a mortgage advisor with specialize in residential mortgages. I take care of clients' needs from purchasing a home for themselves, purchasing a second home, a revenue property, whatever you may have. If you're looking at doing a refinance, either, redevelop your basement, or even if you're just looking to consolidate debt, which I know is very front of mind for lots of us as we come out of COVID and we're in such a state of inflation. That being said, the biggest reason that I got into mortgages is because I am so passionate about educating people on what their options are. So many people think your only option is to be able to go to a bank. They tell you what you qualify for, and that's it. There is so much more to mortgages. It is such a complicated area, but that's why you have professionals like me in the industry. I want to make sure that you are applying for mortgages and signing off on all the paperwork confidently, knowing what the different terms mean, and so that not only do you have a great rate, but you have the best fit for your situation so that you can save more and stress less.
That's amazing, Sydney. Thank you. And I know you do a good job of that because, as I said, I've referred clients to you, and I will continue to do so. So, how long have you been in the mortgage business, and how did you get into that?
I've been in the mortgage business for about 5 years. It's funny, I had started out at a private mortgage investment corporation. So I'm sure not too many people are super familiar with private mortgages. They are very expensive, but a very niche product. And, it was really, I've always wanted to be involved in real estate. It was really important to me as well, growing up, to be really self-employed, business for self, entrepreneurial spirit. And when I started with a mortgage investment corporation, I was like, wow, there really is something to this. And from there, I ended up working with Equitable Bank on the prime underwriting team, which was great. And after seeing all the different mortgages that brokers were putting their clients in, I was like, I don't know if I think this is the right product. And that's what really inspired me to become a mortgage broker so that, I could help people and make sure that some broker or bank isn't just selling the product they're going to get paid on the most, but really make sure that that need is met. This is hundreds of thousands of your dollars, in all likelihood, one of the largest investments you're going to make. You should know what you're getting into. It's important.
It's interesting what you say there because prior to getting involved in the insurance and investment field, I did some foreclosure consulting. And those folks, I feel for those folks, they're in a bad spot, and not judging what got them there or that, at this point, but it really is a tough spot. And you know, to get out of that situation, most people end up just giving up their house, and some of those people can be saved, and some of them have the opportunity to use some of that private lending that you're talking about, which is expensive. But if it can help save their credit, save their family home or whatnot, sometimes those are the only option, unfortunately. But thankfully, those options are there. But for most people, people who you and I deal with every day now, the more traditional avenues are usually what they are able to qualify for and go for. Um, However, there is also what's called, I know the term because of that experience, what's called B lenders. Can you tell us a little bit about B lenders, who they serve, like why they exist, and why someone might need a B lender, to finance their mortgage?
Absolutely. B lenders, also known as alternative lenders, are such an important component to the lending space. Similar to private lenders, they do serve a very niche product. It is a little bit more expensive than your standard prime lending. And when I say prime lending, we're talking your standard TD, MCAP, all of your big mortgage companies. And most of these mortgage companies do have the B arm. And what's beautiful about the B arm, they offer extended mortgages. They're happy to work with you if you have bruised credit and if you're on your way to repairing that credit. And they can get a lot more creative with financing solutions. One of the biggest niches that I've seen utilized in the B lending space over the last year, especially, is debt consolidation, because there's just sometimes if you're self-employed and you're running a business that was severely interrupted with COVID, I imagine you might find yourself in a bit of a cash flow predicament. And that's what is beautiful with a B lender. They'll take a look at maybe your bruised credit because you missed more payments than you wanted to. They'll go into extended ratios. So, if your A lender will only let you go up to say 44% total debt servicing, a B lender will actually let you go all the way up to 60, and then you can consolidate all that debt. You can be in a 2 or 3 year term, so you're not signed up for too long, and then you can refinance into an A lender once you've recovered a little bit.
You mentioned rebuilding credit. I know most of our people watching this are going to be small business owners, and you and I both know small business owners, their financial picture isn't always perfectly clear as someone who gets a paycheck and taxes are taken out, and then they whatever. Lots of small business owners owe money in their taxes, maybe, or they just have less clarity in their financial picture. Is that the kind of thing that might be a good solution for a lot of small business owners?
Oh, absolutely. Especially, so my biggest piece of advice for small business owners or any business owner in general, if you have a tax advisor that is saying, you should pay yourself as absolutely little as possible, et cetera, that's going to make it very difficult to qualify for your A mortgage. Now, what a B lender will do is they'll take a look at 12 months of your bank statements for the business. They'll see the expenses that are coming out, and they'll see all the income going in. And I help my clients put together what's called a declaration of income for a B lender, which essentially lines out maybe what your last year looked like or what your future year is going to look like, what the current finances are saying. And then we can literally state the income for the file based on what your bank statements look like. It's such an important thing for small business owners to know, especially if you've already been turned away from your bank. You can still invest in a home. You can still start building equity. What I always like to say, you can either pay the government a little bit more in income tax, or you pay a slightly higher interest rate with a B lender.
Well, that makes a lot of sense. And as a person who gives financial advice myself, one of the top topics often, especially for small business owners, is I want to pay less tax, right? So you're right. There are ways to do that, especially when you own a small business, right? There's lots of creative legal ways to pay less tax, but there is always a consequence on the other side. Well, I guess depending. I mean, if you earn so much money, you can pay cash for everything. Maybe not, but for the average small business owner, right? They're not in that position, and they will have to get a mortgage for that or a car loan or whatever it is. So those are all things to consider.
Yeah, and just
So
as a small example to piggyback off of that, I
please,
recently I was able to obtain a $680,000 mortgage, and they only paid themselves $10,000 a year. But they kept their cash flow in the business financial statements really made sense. There weren't a ton of expenses. You could see that that's just what their tax strategy was. And I was able to get them a mortgage. So there is always a solution. You just might have to deal with a little bit of interest shock.
that's right. Yeah. And so you also mentioned, as we talked about rebuilding credit, is there a certain threshold where at this credit score you're automatically going to be into a B lender, or is it more complex than that? I'm sure it is, but how does that work?
I mean, there certainly are exceptions that will be made for an A lender when it comes to bruised credit. I would say if you have a credit score of 650 and up, an A lender will be happy to take a look. The space between 600 beacon and 649 points, there are a few A lenders that will look at it, but you might end up having to put a little bit more down payment, or they might ask for alternative sources of credits. Maybe you're renting right now and you can get your landlord to write you a letter of reference saying you've never missed a payment type thing. But I would definitely say as soon as you're under that 600 beacon score, you are going to be looking at a B lender.
That makes a lot of sense. And here's the other side of that too is in many small business owners, small businesses are owned. Well, they could be owned by both the husband and wife, for example, or two partners. The one person may be deriving their income from the business. The other one may have an outside job, for example, and may have better credit than the business owner, right? Due to lots of factors in ups and downs during a business. So let's say a person had a 625, I don't know, just say a random number. If their spouse had a 700 score, for example, they would qualify closer to the 700 score. Am I right? Or
Absolutely. Having a strong credit cosigner is never going to hurt your application. Maybe if you're trying to get your elderly mother to cosign, a lender might not really be okay with that. But if it's kind of like a husband is self-employed and the wife maybe does bookkeeping for the business, but actually has her own accounting position at some company, that will certainly help the situation as well. And then an A lender will be more than happy to look at that as well.
that's fantastic. So we've talked about bruised credit. We've talked about B lenders. Um, what? So I want to dig into this a little bit further here. So is there a simple way to talk about? So let's say someone has um, an example you gave 600 to 649. So someone in that range, you said like an A-lender may look at them. What can they do to improve their picture so that when they go into that A-lender, they have a better chance of getting the good mortgage rate?
Oh, I'm so glad that you asked me. I think half of my job as a mortgage broker really does come down to credit counseling
Good,
because
good.
there are some clients that don't want to be mortgaged and they're like, okay, well, what do I have to do if it's just my credit score? And there are a few things. Obviously, number one that everybody knows, make your payments on time to the best of your ability, even if it's just the minimum payment. I can rationalize a lot of different mispayments with lenders, but if there's lots of mispayments on a lot of
Mhm.
different credit lines, it's going to be a little bit more difficult to persuade them that you're going to consistently make your mortgage payment. What a lot of people don't realize with your credit score is 30% of your beacon score is made up of your credit utilization. And when I say credit utilization, it means how much of your line of credit or your limit on your credit card are you using. It is best if you can keep your utilization at 50% or less. So, as an easy example, I have a credit card for $1,000. I'm going to try my best to keep that balance at 500 or less. Same with if you have a home equity line of credit and you have it maxed out, if you have a $70,000 home equity line of credit and you keep it at 70,000, that will start to slowly tick down your credit score, because what that says to creditors is you really need to access your equity. You're not going to be like you're not really able to manage your finances. So if you're in a position where you have a $50,000 line of credit and your balance is 45,000, not many people can just randomly afford a $20,000 payment. So, what I would
Right.
suggest is call that creditor, call your bank, whoever that loan is with, and ask them, can we increase it? Can we increase the limit
Mm.
to say 100,000 or whatever the case is? See what the maximum limit you can apply for is. That being said, make sure you have the self control to make sure that you're not taking advantage of your new limit. The idea is to keep your utilization at half or less.
Okay, that's great advice. So if the bank says, "Yeah, sure, we'll increase your line of credit to 100,000," does that or how does that affect the qualification for the mortgage itself?
So, lenders, when it comes to qualification for the mortgage, will only look at the balance that is used on your different credit products.
Okay.
Revolving lines of credit and items like credit cards are their debt service. So, the bank will take 3% of the balance owing. And so even if your minimum payment is only $10, if you have a balance of $1,000, they're going to take 3% of that and use that against you to stay conservative. That's what lenders love to say. Oh, to stay conservative, this is what we're going to do. So
Right.
having a higher credit limit isn't going to hold you back. I think this is an old myth that a lot of people still believe in, because it really comes down to the utilization of your credit, not what is available to you.
So here we're myth busting here on open office hours. That's fantastic. I love that show. I always wanted to be on Mythbusters, so that's cool. I'm gonna ask this question only because I know someone is watching this thinking, "Well, what if?" So here I'm gonna ask it is, what if I do have a bit of, uh, you know, playable cash in my business. I take that 20,000 out, put it on my line of credit, get the qualification that I want, right? And then borrow the 20,000, put it back in my business. Is that something that's gonna put someone offside with the mortgage company or is it legal in some way? We don't wanna advise people to do anything illegal, so
So it is very legal. I do caution people, if, say, a condition of your mortgage is to pay off a certain loan, there's nothing in there saying you have to close it unless the lender specifically asks for that, which is very rare. So you're allowed to keep it open, but keep in mind that right up until the day that your mortgage funds and you take possession or whatever the situation is, until the bank releases those funds, it is well within their right to pull your credit bureau again. And if you decide to take out a new car loan, or if you re-advance those funds from a line of credit and the lender decides to pull your credit bureau again, you're just going to have to end up paying it off again. So my best advice, if you need to pay off a little bit of debt to make ratios work, or whatever the case might be, if you're thinking about buying a new car to go with your beautiful new home, just wait until you're in it. Really just wait until you have the keys and your stuff is moved in, and then absolutely go crazy again if you wish.
I was gonna say, yeah, wait until after you've got the funding completed and then play around with your money again if you want to.
Exactly, because once the funds are released, even if the lender determines that everything about the mortgage was fraudulent, they can't just take the money back without going into a whole legal thing. So I really do caution people, especially if you're looking at purchasing a new home and you have to keep an approval open for over 12 months. It is so tempting to get excited and start buying furniture on credit, maybe a new car, who knows? Maybe you're wanting to buy your son a graduation gift. Just wait until you're in your new home. Wait until everything is final, and then the world is your oyster again.
And that's a good point, and that brings to mind, you buy that nice new house, you qualify for it, you move into that new neighborhood. Lots of new neighborhoods going up in Calgary, right? So move in that new neighborhood, and then your neighbor moves in, and they've got a nicer car than you do, and it's like, oh, maybe you feel like, oh, I don't belong in this neighborhood now, right? So there is that. I can see that temptation. Oh, I got to upgrade my car or buy a nicer truck or whatever. So yeah, for sure.
New house, new you. Absolutely.
You mentioned a lot of your job, 50%, I forget the number you said, is really credit counseling. And my job is largely financial counseling too. Is it's not just you should buy this or sell that. It's like how do you manage your money, and that goes hand in hand with what you're saying there. That's a perfect fit. Cool. Um, so here's a question that's on some people's minds, I'm sure, is so let's say I found a house or property, whatever it is, whatever kind of property I want to buy and move into. I think I can afford it, and I think my credit is okay. And I come to you and I say, okay, hey, I want to. Well, I guess first question is, what is the first step they do? Is it putting an offer in the house subject to financing, or is it calling Sydney Widmer? First question.
Please call Sydney Widmer first. It will save your realtor a lot of gray hair and you a lot of stress. That being said, I understand sometimes you just end up in a moment where it's just like, I impulsively have to do this. I know there's going to be competing offers. I'm just going to go in and write it. And that's okay. Keep in mind, there is some discovery that is required during like my first step. I will always call a client, kind of get a picture of what their life looks like, what their goals are for the home. Maybe they're flipping it, which will affect what product I put them in. Maybe it's their forever home, which will also change my mind on what product I recommend. So once I have that discovery call, I need to start collecting documents and information. I'll have everyone fill out an application, provide a consent form so that I can fill out or so that I can pull their credit bureau. From there, I'm able to run correct and accurate scenarios based on current rates, what your income looks like, what your debt load looks like in relation to the cost of the home. It is always best to do this ahead of time so that your realtor could even go in and say, well, we only need 2 days for a condition of financing. We've already done all the legwork. And part of that legwork as well is getting all of the documentation involved. And for small business owners, I have to warn everybody ahead of time. There is going to be a fair amount of documentation required. So I do definitely recommend 100% wholeheartedly to make your life less stressful when buying a home or even refinancing or renewing your mortgage. Get the pre-approval, start getting the documents in a row because I'll be asking for things like your T1 generals, your potentially your business financial statements. If you're incorporated, I'll certainly need your CRA notice of assessments. And sometimes these things can take a few days to collect. So it really
Mhm.
is important to start that pre-approval process so that you can shop with a realtor confidently.
That's good advice. You mentioned 2 days to do the financing. I know that's not the standard, and that's
That
maybe if
is
you have
not the standard
all
yet.
your ducks in a row, right? All your ducks in a row. So my next question is, how long does it take? So I come to you and I say, okay, hey, I think I found this house. I think I my credit's good. How long is the process for you to, you know, is it a week? Is it a month? Is it how long
Absolutely.
does it take?
For me to run scenarios for a client, I can do it within as quickly as a few hours after receiving all of the information. Now, that being said, that is just the first layer, like layer number one of your mortgage approval. The next layer is the lender approval. And that can take right now in this market because everybody is so busy, that can take about, you know, 3 to 5 business days, depending on what lender we're going to. And then the next layer of approval that the lender will also get in tandem is the insurer approval. So I can say, yes, you look great. Send me the offer. We have the pre approval. Ratios are in line. Perfect. The lender can look at that and say, yes, we love this client. They look amazing. We don't see any red flags on the property. Perfect. But then it might go to the insurer, and the insurer might turn around and say, you know what? We had a fraudulent appraisal coming on this property. We're going to ask for a bunch of extra due diligence, or they might just reject the property entirely because they're worried about the sellers committing fraud or whatever the case might be. So just because I have you pre-approved doesn't mean that the property is going to be pre-approved. And lenders and mortgage insurers certainly have access to different information than I do. Uh, Different levels of fraudulent kind of whistleblowers, you could say. So there are other layers beyond just the mortgage amount. I can clear your mortgage amount in a couple hours. If you're looking at buying a home today with how hot the market is and how busy the lenders are, I really recommend 7 business days for a condition of financing minimum.
Something you said brought up a question I'm going to ask in a minute, but first I want to ask you the difference between is there a difference between pre-approval and pre-qualifying?
There is a huge difference. Yes, I am very glad that you asked me this. A pre-qualification has no hit on your credit at all, and you're not locking in a rate with a lender. You're really just, it's the equivalent of running scenarios on TD Canada Trust's mortgage calculator. Who knows if you're really qualified for it, but the numbers work. When you are pre-approved, it means that I've pulled your credit bureau, I've submitted it to a lender for locking in your interest rate, and they've approved the bare bones of the application. They don't review documentation in the pre-approval process, but they do look at the application. They see the details I've submitted, they've seen the notes, and they're like, yeah, you know what? These people make sense. We're gonna give them some cash to buy a house. Absolutely.
Cool. So you mentioned they don't review the documents at that stage. How often does a home or a purchaser get to the get that approval, pre-approval, and then go to further stages where they go, nah, we're not so sure about you now. Is that
In
common
terms
or
of
not?
declining the borrower, it really depends how upfront the borrower is with me. So I will say for my small business owners, I do like to get all of the documentation upfront just so that I'm running 100% accurate scenarios for you so that there aren't any surprises. A lot of small business owners might be a little shy to actually say what they're paying themselves. There's all these different things where they think like, "Oh, well the business made 300 grand last year, so I'm going to be good to go." Well, I appreciate that, Susan, but you only paid yourself 25. So we can't use 300 to qualify unless we go to a B lender. So one of the perks of working with me is that I do a fair amount of the documentation collection up front so that once you have that offer in place and all the stress levels rise because you have real money on the line, you can just sit back and know that I have your best interests at heart and we are going to get you the best mortgage for your situation with the accurate numbers because I've already seen them. There are no surprises at that point.
That's really cool. That's really cool.
One of the benefits
So,
when I do
oh,
look at mortgage documents, I used to work at a lender. When I was at Equitable Bank, I specialized in doing self-employed deals. So I really know what
wow,
I'm looking for. And when I'm working with small business owners, I'll take a look at it as if I'm still at a bank so that I'm looking for red flags so that I can ask people ahead of time like, "Hey, what happened here?" or "Hey, I noticed this." And it's all about getting those things mitigated up front so that once you have the offer, it's smooth sailing.
that's awesome. That's something that I mean, I don't know. I haven't run the stats on mortgage brokers, but I'm sure that you're unique in that scenario in that sense that you've worked for the bank in that and specialized in small business owner type application. So that's really cool. It's really exciting. So you mentioned or maybe you didn't mention it, maybe it just popped in my head was so types of properties that may be tricky to get a mortgage on. One that comes to mind only because not where I live now, but I used to live in the Northwest and just down the street was a former drug house. Is that something that I can get? I may get a really good deal on this house. Is that something I can get a mortgage on? I've heard that you cannot get a mortgage on a former drug house. What's the
It
scoop on that?
So it really depends on how remediated the home is. If the home is totally remediated and we can send in inspectors to prove to the lender that that all the issues have been taken care of, there is no damage, there's no mildew, there's no mold, none of that, and everything's been remediated. Absolutely. I actually just had a conversation with a realtor not too long ago because her clients were purchasing a former cannabis grow up, but it had been a few years ago, all of the work had been done and we did disclose it in due diligence. It's always important to go all in and disclose everything you can so there's no nasty surprises. But because the work was done, it wasn't an issue. Now, if a meth lab is busted and then you try to buy the house the next day, that will be very difficult. Yes. That will be a very tough sell.
I'm sure. I'm sure. Um, well, yeah, the police haven't even finished their investigation. So,
Exactly.
yeah, exactly. So here's another one for you: raw land or an empty lot. Are those the same thing? And if not, how do those vary? Let's say I want to buy some raw land and temporarily put some, a trailer on it or something, just till I can build my dream house. Compared to buying a raw land, an empty lot in the city that I'm gonna build on.
Yeah, so it is essentially the same because it's very difficult to get a mortgage without having a home on it because A lender, especially in the residential mortgage channel that I'm in, they're going to look at that and say, well, you can't live there. We're not going to mortgage the property for you. So, on the raw land deals that I've been faced with, what I end up doing is I have the client refinance their current home, or we will just pull out a home equity line of credit and purchase the raw land with cash. Then if the client is deciding to put a home on it, or if we're looking, at putting a modular home on it, as long as you're on a proper foundation, at that point, once construction is complete, you can go to any lender, refinance that property, get your mortgage, pay out your home equity line on your principal residence, and you're off scot-free.
You're not talking wheels and axles, right? That's not a proper
Yes, we are talking at least steel piles. We are talking concrete foundation in a perfect.
foundation, right?
Yes. Yes, and
So
those are certain things that lenders will look at. So they wanna know, especially if you're building, is it on a proper foundation? Because if it's something just like a fifth wheel, well, that's not a house, we can't finance that. So it does need to be that proper modular home. I will need all the builder docs, of course, an appraiser will have to go out to make sure that nobody's lying about anything and different things like that. But, I'm working on a deal right now in Sundre. They had purchased the raw land with cash. They had given all the deposits to the builder, and now construction's finally finished. So we're pushing through the refinance for them so that they don't have to pay $200,000 for their home cash.
nice, nice, nice. So, along those lines, tiny homes are the big thing right now, but a lot of tiny homes do have wheels. I don't know. I don't know how many of them are stationary, but that's probably the same thing as a fifth wheel, right? If it's not stationary with a foundation, they're not going to get financed on that.
That is how the lenders in the broker channel absolutely look at it. I have yet to see a tiny home that is on wheels and not a proper foundation being financed successfully. Now,
Right.
that being said, there are certain lenders that aren't in the broker channel that will consider it. As an example, it is very difficult for me to get my client a mortgage if they have a mobile home in a mobile park, because technically that is a chattel mortgage because it's on leased land. So but you can still go in branch and probably get financing for it. It's just out of the broker channel. So our niche is certainly those big permanent fixed homes. We're not looking at moving them anytime soon. Like, it is going to be permanently situated on that land, uh, with all the different new home warranties and postal codes that go with it.
Cool. And so, what about things like, let's say I wanted to buy a motel in a small town, or a hotel, like those hotel bars in small towns, or something like that, or a convenience store. Is that something that you can get a mortgage on, or is that a whole different ball of wax to what you do?
So you can get a mortgage on it. It is a little bit of a different ball of wax. While I am licensed to sell commercial mortgages, my specialty is certainly in residential. However, I do have an amazing commercial mortgage broker that I would happily recommend to any small business owner looking at purchasing that. Absolutely.
That's good to know, because yeah, I mean, not everyone thinks about those kind of things, but a lot of small business owners do, right? So where
Yeah, and
there's an
sometimes if you're
opportunity.
exactly. And sometimes if you're looking at purchasing, I actually have a realtor friend of mine, and one of her friends is looking at purchasing kind of a plot of land. It has a liquor store on it right now, which means that it's zoned commercially, so it has to be a commercial space. But honestly, it was such a small sale price that even though I tried to help him, I couldn't. All the lenders were like, well, no, we need it to be at least $2 million before we're going to consider it.
Wow.
So there's that as well in the broker channel. There are certain minimum pricing. And this liquor store land was priced at about $400,000. And I was like, honestly, it will be a lot less expensive if you just go to the commercial banking branch of your bank.
Right. Yeah. Well, that's good to know. And I appreciate that about you, is that, if you don't have the best solution for them, you will refer them off to somewhere else.
Absolutely. We're talking about people's investments. We're talking about growing their wealth. It is important to me that they get the best service that they can, whether that's with me or somebody else.
Now, you deal with these things all day, every day. I only touch on them here and there because it's not my specialty. What are some of the questions you get asked that I maybe have not thought of to ask you that you think people should know, particularly small business owners, but anybody who's looking for a mortgage? I know rates. The number one thing that people think of, or I think of when I think of mortgages, well, there's a lower rate, or there's a rate sale here, or But what tell us more about that if you can. What's the real scoop on rates? And because I know as one thing I do know is that the lowest rate isn't always the best mortgage, and maybe you can explain why that would be after you take a good long sip. Excuse me, I need to take a sip. Um, and maybe you could explain that, and then any other questions that people ask that I haven't thought to ask you.
Yeah, absolutely. So you are absolutely correct, Corey. Usually the lowest possible mortgage rate is probably not going to be what's best for the client. Now, the reason for that, so we all know that mortgages are these huge complex documents, but there are a few terms in that document that I do want people to be familiar with. And when I say terms, I'm really talking those different clauses like for a fixed mortgage rate, portability. And the reason that portability is so important is what if you purchased a home in 2021 and you have a 1.75% interest rate? You're looking at upgrading because maybe you had a baby, you need another room, more space, or it's just you're moving for work. You don't want to lose that 1.75% rate. How nice would it be if you could just port it over to the next property? That's
Thanks.
something that you don't get in a heavily discounted rate. Same with your prepayment privileges. Maybe not everybody has the capacity to put down 20% of their mortgage, but the mortgages that I recommend for my clients offer prepayment privileges like that, where you can not only do accelerated payments, but you can increase your payment by up to 25% per payment. So you're putting so much more into your principal, you're paying your home off so much faster. And same with the lump sum privileges. If I know there are lenders like ATB, RFA, MCAP, they allow a 20% principal repayment. You could hypothetically pay your mortgage off in 5 years if you wanted. I
Wow.
don't know too many people that can do that, but it's an option. And these heavily discounted rates that you see not only do not offer them, offer different benefits like this to the mortgage, but they also restrict you. There's usually a bona fide sales clause in those mortgages, which means that unless you sell, you cannot do anything with your mortgage. You cannot refinance it. You cannot renew early. You cannot have a second mortgage go behind if you need to. Literally, unless you sell your house, you are really stuck. And then, even if you do sell your house midterm, the payout penalties are so much higher. So,
Wow.
while it is so important to make sure that you do have a good rate, because at the end of the day, it's all about making your home cash flow. We really, and being able to pay off that principal as soon as you can. I respect and understand that. I don't think losing all these options are worth saving $40 a month. And sometimes that's really what it comes down to. I'll always run the amortization schedule for my clients so that they can see what the difference looks like in 5 years. Because my biggest hesitation there, statistically, 60% of buyers will break their first 5 year term on their mortgage.
60%.
60%.
Wow.
So I don't know about you, but I would like to err on the side of caution that I will probably be part of that 60. And it's really important to have options.
Yeah,
So
for
when I
sure.
tell people, like, I will get you a great rate and the best fit, the great rate is important, absolutely. But there are other terms and benefits to maybe paying 5 basis points more. Now, if it's a whole percent difference, that's a very different conversation. But usually you're talking about zero point 0.1 or 0.05% difference. And honestly, that really does just equate to 20 or $40 a month, depending on what your mortgage is. And it's kind of like go to
Wow.
Starbucks a little bit less and have some freedom with your mortgage. Life changes. It's important to keep some options open when it comes to your mortgage.
Yeah, maybe maybe cancel your Disney Plus as one famous politician recommended. I'm kidding. I'm kidding. Don't do that. um, cool. So, no, I had another thought, but it'll come back to me. So, is there any? Oh, I know what it was. Um, so, a couple. One is, there's a lot of talk right now. You mentioned the 1.75, for example. We know that isn't the going rate today. A lot of people who did finance, and there were different stress tests or whatever, but maybe their situation, their income changed or something. In addition to now the rates are changed, we know inflation has gone up, right? Food costs, gas, things like this are more. Um, what like what are some ways that people who are stuck
right, in a mortgage that they really can't afford, what is one or two, or I don't know how many different ways there are, but what are some of the ways that they can sort of overcome that or mitigate that without losing their home, without, what are the common ways that you help people deal with that challenge?
So the most common way that I have helped people with that is definitely re-extending the amortization. So the amortization is how many years it will take to pay off the mortgage in full. So usually that's 25 years when you purchase a home. If you purchase a home at 25 years, you come up for renewal and there's absolutely no way you're going to qualify or be able to make the payments. You can re-extend that amortization. So after you buy your home, you have 25 years, fast forward 5 years, you now only have 20 years left. Take it back out to 25 if you need to, or even take it to 30 if you have to. And one thing I will mention about B lenders, some of them will go all the way to 35 to help you cash flow so that you don't lose your
Wow.
home.
Wow, that's amazing. That's one of the questions I was going to ask is how far out you can take it. So now, thankfully, in Calgary for a number of years recently, house prices didn't go up at all. Some went down, depending on the kind of property you're in. Lately, in the last few years, thankfully, they've been going up in value, which does give people a bit of a equity cushion there, right, in their property. So now
Absolutely.
I could see where you could 5 years, 5 years ago you bought it, now it's gone up. You maybe need to extend it while you've got more than 5% equity as well, right? You've got maybe you have 20% equity now. So you
Exactly.
can go further. Another question I was going to ask you about, what you mentioned insurance, the insurance part earlier. You're referring to, just so we're clear, CMHC,
Yes, the
and
mortgage
there's
default insurance.
right,
Absolutely.
right. So, and that's required. I think, I don't know if it's required by law, but it's usually required by lenders when you're borrowing more than 80%. Is that correct?
Yes,
Yeah.
that is
So,
correct. Absolutely. And then when you're borrowing, so if your down payment is less than 20%, you will be required to pay that CMHC fee. There's two other insurers, but we all know CMHC, so we'll just keep calling it that.
sure, sure.
Um, if you're putting down between 21% and 35%, you're actually in for a slightly less competitive rate because what lenders will do is they'll back end insure, which means now they're the ones paying for the insurance instead of you. They're the ones paying the CMHC fee, which is why you don't get as competitive of a rate. And then
Right.
once you put 35% or more down, you end up with the same rates as if you were putting less than 20% down because the lender turns around and says, oh, this person's heavily invested in this property. It's less risk for us. We're going to give them a better rate. And we're not
Right.
paying for the insurance anymore.
Nice, nice. And just for the record, what was that rate again? 21% to
35.
35%? Okay, just want to make sure that we're clear on that. Okay. And the other thing I was going to, I don't want to put you in a tricky position here because, I don't know exactly what your situation is with regards to mortgage insurance, but as a person that sells life insurance, and critical illness disability insurance, um, there's been a lot of talk about the mortgage insurance that comes with, like, from the big lenders, for example, isn't all it's cracked up to be. And again, I don't want to put your foot in your mouth, and I'm not trying to trick you in any way here, um, but can you comment on that or not?
No, I can
Is that
absolutely comment
okay?
on that.
Yeah,
As a
yeah.
mortgage broker, I am legally required to offer a mortgage life insurance product or a mortgage protection product to every single one of my clients.
Okay.
Uh, the way that our end works, the program that we use here at Mortgage Tree, I am legally obligated to offer everybody Manulife's protection plan for their insurance. I also urge my clients to decline it, and I happily recommend them to yourself because I do truly believe that you should protect your assets. Life changes, you can't predict unpredictable events. It is important to make sure that your family home, that your life, that your kids, that your partner, they're taken care of. Do I think big lenders have good products? I cannot say that I do. That being said, I'm not an insurance expert, but I know that they don't underwrite until the time of the incident, which makes it very easy for them to get out of having to cover your mortgage. So I do recommend that they talk to an advisor who's actually licensed to sell different products so that you can find the best product for them.
Right, and I appreciate that. And that is where I was going with that too. Is and full disclosure, one of the companies that I do represent is Manulife. Um, but it would be a different product. It would be an underwritten product as opposed to as you
What
mentioned,
I offer.
the ones that are not underwritten. And yeah, and so that's something that I can help anyone with who's looking at a refinance or a first time finance of a home or whatever. Is you do make sure that's properly insured. Just because it is a different product and that's complicated and could be confusing, and I don't not trying to overwhelm anybody here with that, but I did want to touch on that just briefly. So we'll move on.
Of course, of
um,
course.
cool. So yeah. So anything else? Any other hot topics that you guys chat about around the water cooler that people should know about, or questions I haven't thought to ask you yet?
Well, I do want to just continue a little bit of a conversation on rates because lots of people, we've had a lack of inventory in Calgary for a while now, all over Alberta, to be honest. So I do just want to touch on what rates are doing because lots of people got qualified, maybe last winter when rates were significantly lower. And now everybody has this rate shock because we are sitting around that 5.29% mark. I would love to just calm everybody down with it, assuage all nervousness. We are still very much within a normal realm of interest rates. Over 25 years of your mortgage, you can expect to see anything between 3.5% and 5.5%. And that's where we're hovering around right now. Yes, I agree. We are on the higher end of the spectrum of rates, but at the end of the day, it is normal. And until it's getting to 10%, there is really nothing to panic about. And on that note, I do just want to say we have another Bank of Canada Prime announcement coming up. If anybody listening is in an adjustable or a variable rate, I have a feeling it's going to go up again. But the beautiful thing about your variable and adjustable rate is that as fixed rates start to come back down, you can lock in with your lender penalty free as soon as you see a fixed rate that you like.
Nice, and that's a good point there too. I wanted to ask you about. So, variable rate and fixed payment. I don't want to misquote you. What the terms are called, but there's two different kinds of. There's your fixed rate, right, and
Yep.
then there's your variable rate, and then there's another kind of variable product which has maybe a steady payment, though the rate can vary, right? Can you just maybe unconfuse people about that for me?
Of course, of course. So your
Thanks.
fixed rate is exactly how it sounds. Your rate is locked in for the length of your term right up until renewal. Usually it means there's going to be higher payout penalties because they're guaranteeing you a rate. However, most fixed rate mortgages offer portability options and you're able to do a little bit more manipulating with them. Right now we're looking at about 5.29 to 5.5 depending on what your loan to value ratio is. Um, and if you're financially conservative and you value predictability and stability in determining your budget, I will always recommend that you go fixed. Then we have adjustable rate mortgages. And this is the variable rate where you'll have your prime minus a certain percentage. If it's insured, it's usually prime minus 0.9%. The adjustable rate, though, means that the same amount is always going to go to the same ratio will always go to your principal and your interest rate. So when the interest rate goes up, your payment's going to go up.
Hmm.
And then you have a true variable payment. The variable is where your payment stays the same, but the amount that you contribute to principal versus interest can change. And what does get dangerous there is that even in a variable rate that's fixed payment, you might end up getting triggered to have to pay more because now you're no longer putting anything into your principal. 100% of it, maybe 110% of it is going into your
Yeesh.
interest.
Yeah, that's scary. And let's just, for example, let's just throw some sample numbers at that. So let's say your mortgage payment is $1,000, right? On a fixed mortgage, fixed rate, it's $1,000 for the term of yours for that 1, 2, 3, or 5 years, whatever, right?
Yep.
On the variable rate, the amount could change. It could be 1,000 this month. It could be 1,100 next month. It could be 1,050. It could be
The adjustable, yeah.
995, right? On the adjustable, sorry. On the other version, you could be paying, and of that $1,000 on your fixed rate, just for example, let's say 900 of it is interest, 100 of it is principal, right? Within that particular month.
Mhm.
On the other one, because the amount is varying, it's going to still be 9 to 1, for example, right? In that example. Whereas the other one, it could be like you were saying, 100% interest or more of that $1,000 could be interest, and zero or negative. You're not even paying enough to get any. And the danger there is, of course, depending on the property you're in. I mean, if your property is a type that's going up in value, you have a bit of a safety net there when you do eventually have to choose another mortgage product, right? But that's not guaranteed, right? We all know house prices are not guaranteed to always go up, just like the stock market is not guaranteed to always go up. So if you're in a situation like that where you're paying more interest than or 100% interest, right, and you're not paying down any principal, and the value of your house goes down, well, now you could be in a really tricky spot, a secondary really tricky spot when it's time to redo that mortgage. So yeah,
Absolutely.
interesting. Sure.
I have to
So
say, in this current climate that we're in, especially with variable and adjustable rates being higher than fixed, I really am recommending more fixed products to my clients, especially because of the rate shock that everybody is experiencing. It is not a good feeling to renew your mortgage or to go from month to month and see that you're now paying $1,000 more than you were last year. I think variable rate mortgages, I mean, over 25 years, if you stick with variable the whole time, you'll for sure save money on interest. But I do think there's something to be said for saving yourself some stress and saving yourself some sleepless nights. I think variable rate products are really good if you're an investor and you have a tenant in there, you're writing off the interest anyways. It doesn't really matter. You can always increase the rent if you need to, make it somebody else's problem. It's also really good if you have really significant cash flow, or if you are taking advantage of your prepayment penalty, or pardon me, if you're taking advantage of your uh, prepayment privileges and you are putting down that extra 20% per payment or doing 20% per year, there always is a time and place for every mortgage product. It really depends on what you want and what will work best for your life.
you can help people understand exactly how much they can save in interest by doing that. So one thing I'll say here, just again, in terms of full disclosure, as a person who gives financial advice and creates financial plans for people, sometimes putting that extra $100 or 20% or whatever that is against your mortgage, if your mortgage if you're being charged a rate of 2% or even 5%, right? If you are well invested in something that is giving you a higher rate of return than that 5%, it may be smarter to, I say maybe, every situation is a little different. It may be smarter to leave that invested, right? Not, or invest that extra $100 you have into whatever investments you have that are already earning more. So let's just say, for example, you're earning 8%, right? You're earning 8%, but you're only paying 5% on your mortgage. That extra 2% to $200 or whatever could serve you better longer term. It may not. So something to look at the numbers, look at it both ways.
Oh,
We'll see.
absolutely. I do the
We'll
same
see
thing
what.
with my clients when they don't know how much to pay themselves to qualify for an A mortgage.
Right.
I run the amortization schedule so you can see what you're paying in interest over the term of your mortgage. You can take that to your financial advisor, your tax advisor, the team of wealth knowledge that you have, and you can say, what do you think is better? How much am I going to save on this? What am I going to get on return here? There's so many different things. That's why I'm so passionate about the education side of it. You need to know what your options are. Maybe in your atypical business scenario, going down the beaten path isn't going to be what works for you. Maybe you should be in a B mortgage and just at the most doing accelerated payments because Corey's getting you 8 to 12% on return.
Right.
Every mortgage is different. Everybody's needs are different. And I think that's why Corey and I complement each other's businesses so well because we both want to build wealth for our clients. I do it through mortgages and he'll do it through the magic he works.
Absolutely. And yeah, I agree 100%. And clients don't have to do what I tell them, right? I give the advice. It's the client's responsibility, actually, not just their privilege. It's their responsibility also to make the final decision, right? And because they're the ones that have to live with that consequence. So if a person says, look, I know you can get me 3-4% more or whatever the number is in that scenario, by investing it, but I just really feel better paying down the mortgage. That I will tell them, pay down your mortgage. Peace of mind, sleeping well at night. That is more important
Absolutely.
than a few extra points on a few hundred or whatever dollars, depending on the situation. So, Absolutely. Always do what's best for the client. The other thing I would just want to comment in terms of a disclosure for those that are watching, you and I are both in Calgary here in Alberta. So, when I talk about the trends that, I referenced for the prices of homes and that, I'm talking about Calgary. I'm talking about Alberta. I'm not talking about other parts of the country. Having said that, I am licensed in British Columbia currently, British Columbia, Alberta, and Saskatchewan. Where are you able to do mortgages for folks across the country, around the world, just in Alberta?
I wished around the world. That's step 2. Stay tuned for international mortgage broker. No, I am licensed throughout Canada. I am able to do mortgages across the country with the exception of Quebec, which I'm totally fine with. I love talking about mortgages in English. I am hesitant to do so in French, much to my 8th grade teacher's dismay, I'm sure. That being said, RICA, the body that governs me, is a little bit strict. I just can't advertise in BC. But if you're looking at buying a second home, or you have a friend and you listen to this and you're like, oh, they're up for renewal, they should really give you a call. Absolutely. I am very much here to help.
Yeah, and I am actively building my business in helping business owners in Alberta and British Columbia mostly, partly because Saskatchewan's a smaller market, and partly because I usually only get back there for Rough Rider games. Sorry, everyone, west or east of Saskatchewan, I'm a Rough Rider fan, but most of my clients will be in Alberta and BC. So definitely, and this is not an intention to actively advertise outside of our legislated areas. But if you found us by some means and you want to reach out to us, please go ahead and do that. Speaking of which, before I forget, I'll mention, and I got to learn how to point backwards in the mirror. If someone wants to get in touch with me, they can scan this little QR code here. Let me just make that a little bigger just for a second, just so that's a little clearer. Sorry to shrink you down there, Sydney, but yeah, so just go ahead and scan the QR code here if you want to get in touch with me. I do give a free discovery call to anyone who wants to know more, wants to know more about me, or just really to see if we're a good fit to work together. I do work with folks who aren't business owners. But the majority of my business is to small business owners for the reasons that I mentioned earlier. Now, if you want to get hold of Sydney, how will folks get a hold of you if they want to know more
Have my
and
slide that we pop up?
I don't have. Did you email it to me? I'm sorry.
You responded and said it was great.
Did I? Sorry about that. Hang on one second. Bear with me, folks. I've been a bit sick for the last 2 weeks, so I may say things and not remember what I said.
Pain meds are a hell of a drug.
Yeah. Well, actually, I didn't take any meds. That's probably why it took me 2 weeks to get over that. This is a common cold, but let me just open my email. I apologize, folks, but we'll play some Jeopardy music or something in the meantime. All right, where are we here? Now it's got to wake up. Shut everything down because we're having technical issues earlier, and now I got to wake it up. So, but in the meantime, is there any other things that people ask you about, or questions that you hear about, or thoughts that people might have that you want to address while I'm looking this up?
The last item that I will discuss when it comes to rates is that the benefit of purchasing a home or getting involved into real estate when you have higher rates like what we're looking at right now, you're at less risk for renewal shock. We're at the higher end of the spectrum. Yes, it will limit your buying power, but what that ensures is that when you go to renew, you don't have to worry about your mortgage doubling. You don't. Now, somebody who purchased at 1.5% is never going to see that rate again unless another global pandemic happens. And here is hoping that never happens again on our planet. So that is the silver lining. When you look at rates and you're like, oh, they seem so high, I'm not qualifying for what I want. It's not the worst thing to know that you are living well within your means, and you're not going to be surprised one day by not being able to afford your mortgage payment.
Cool. That's good advice. I appreciate that. All right. I'm going to let's see here. I'm going to improvise a little bit. I'm going to share my screen. It's funny, the share screen button is always in bright green, and I always go right past it and go, "Where's that button? Where's that button?" Every single time.
Oh, Zoom, you're killing us.
Yeah, I know, right? So here's the information, contact information for Sydney. Nice. So just again for people, pre-qualified is just sort of like, do the basic numbers match up to where you could afford a mortgage? Pre-approval is you're actually approved for a mortgage of X amount, right? And so here's a quick question. One quick question here. I'll leave that up if that's okay while we chat here. Um, Let me just do this actually, and then I can. Nope, that's not going to work. Okay. So let's say someone is pre-approved for 500,000. That's the number you threw out there. So I start looking around and I'm going, okay, 500. Okay. Now this one here, oh my gosh, this is our dream house. It's 550,000. What do we do? How complicated is it to come back to you and say, can we get another 50,000 approval?
Well, when I run pre-approval scenarios for my clients, I always give them more than one option. I want them to know what their absolute maximum amount of mortgage they're qualified for is. And then I usually ask them, like, what do you want to pay per month in mortgage? Like, do you want your mortgage payment to be $1,000 or do you want to pay $5,000 a month? And then I'll let them know what that amount is. So they'll probably already know what the absolute maximum is. But if you're ever looking to extend those ratios, that's what B lenders are for.
Right. So in a scenario like that, let's say your max was 500 and they absolutely have to have this $550,000 home. Do they start over with an application to a B lender, or do they go to the B lender for the 50,000?
I would say start over. Well, you're not starting over the application. I just send it to a different lender for them to adjudicate the file. So I'll already have all the information I need. It's really just a matter of me choosing the lender to send it to. So it's not restarting the process in any way. It's just getting a different lender to take a look at it.
Good to know. So not another 5 to 7 business days or whatever. It's we've got everything compiled. It's just lender B. Let's ask them what they think.
Exactly.
And generally, without speaking to anyone's specific situation, generally in those scenarios, if you qualify for in this example 500, it's probably not that hard to get the extra 50 from a B lender, right? Yeah,
Absolutely. And honestly, sometimes there are even exceptions that A lenders will make to have slightly, like, have ratios be slightly over. Like TD, I know in the broker channel, they'll actually go up to 48%, whereas a lot of lenders will keep it at 44%.
right.
My biggest caution there, because I am passionate about helping my clients build their wealth, if you're in extended ratios, if you're going up to 48%, that means almost half of your gross income is going into your debt load and the house. So I would really caution. I know you love this home. However, you're going to, like, I hope you really love it because your budget will feel it.
Yeah.
Like, I can probably get the mortgage done, but it really comes down to, how much of your lifestyle do you want to sacrifice just for an extra $50,000 as an example?
That's right. And as a rule, I don't recommend someone take money out of their investments for something like that, right? Beyond what they need for the down payment. But in a case where I get it, I know how it is, right? If you're like, oh, the only way we can do this is to cash out some of our RSP. Well, then we need to adjust your strategy. And I can do that as we have this amazing software. I can look 30 years out in the future based on what we know now about the tax codes, for example. We can project their taxes out 30 years, which is amazing to me, right? We
That's
can
amazing.
look, it is amazing. And we can say, like, okay, if we take this 50,000 out now and put it on your home, what else do we need to do? What other strategies can we employ with the money you have in your account to get that 50,000 back, right? Or what other cash flow? Because cash flow is one of the things that I help people with. Is what else can we do with your cash flow to help you? And that's one reason why I help people grow their business wealth, not just their portfolio wealth, right? Who can I connect you with in my network, like Sydney and other professionals, to help you get that 50,000 back? How can we increase your sales? Can we, whatever, what can we do in your business to help you get that back so that you can have that dream home? I'm about helping people get their dream lifestyle. That's what this is. If it's a camper, on a mountainside, or if it's a mansion, whatever, I want people to get their dream lifestyle. So and the business should fund their dream lifestyle. So,
And the
so it's
mortgage could help get you there too.
absolutely, absolutely right. It's all part of that one big financial picture. So, we've gone a bit over. I thank you so much for your time, Sydney. I don't want to keep you any later. You may have some leftover Calgary Stampede partying. It's Calgary Stampede week right now in Calgary. So, if you're watching this at another time of year, that's what we're talking about. So, thank you again so much. This has been so helpful, so fantastic. As always, you're a great resource, a wealth of knowledge, and I can see how you're going to help clients grow their wealth and live that dream lifestyle that they went into business to live. So thank you so much,
My
Sydney.
absolute pleasure. Thank you so much for having me, Cory.
All right. You're welcome so much. Yeah, and so again, just before we go, one last thing. All open office hours is every Tuesday, normally from 7 to 8 p.m. Mountain Time. The first Tuesday of the month, it is at 8 p.m. Normally. And just check Eventbrite for the updated listings for, for the week that you're looking at joining. I am taking next week off. I'll be on vacation, and we'll have other experts come in after that. They'll be fantastic as well, just like Sydney was. And so thank you so much. Get in touch with us and see how we can help you. That's what we're here for.